Amit Jeswani of Stallion is with us now to talk about his thoughts. I mean, there's just so much data to talk about. I'll cut straight to the chase. You've looked at consumption names very, very closely. I think your portfolio comprises largely of them. What did you make of what HUL delivered and what HUL had to say with regards to the quarters ahead?
Good morning, Neeraj. Thank you so much for having me on your show. It's been tough, Neeraj. It's been tough. It's been extremely tough for the last 18 months, very honestly speaking. I'll just go in HUL in 1 second, but if we look at what has happened in the last 18 months, people have got killed. Literally, portfolios have got killed. If long-term capital gain tax didn't kill you, then ASM killed you. If ASM didn't kill you, just in case you survived the ASM crisis, then it was basically the mutual fund selling that killed you. If mutual fund selling, you survived the mutual fund selling, then the NBFC crisis killed you. If in case you survived the NBFC crisis, it was the business cycle slowdown which killed you. And of course, you had promoter risk, and now you have a bad budget. The last 18 months have been tough. The economy is getting really challenging and weak for everyone, for every sector. If you look at all annual reports this year which have come out, they start their annual report by saying that we are witnessing one of the largest slowdowns and demand is extremely weak. This is the first time we have an India-specific crisis, Neeraj. 2013 was not an India-specific crisis. 2008 was not an India-specific crisis. It was after 1997 when there was NBFC crisis that time, and 1991. These are the two India-specific slowdowns that we have seen. FI money will go out of the system, but this will give us a good buying opportunity. If we can get quality stocks at cheaper prices, I believe that would be a good strategy, buying good businesses when it makes a lot of sense in India to buy good businesses when they come down 10, 20, 30%. Consumer, we don't have HUL in the portfolio. Yes, our portfolio is 25% consumption, but our companies are growing at 30%, so that's not a problem till now. But HUL, it looks weak, Neeraj. It looks really weak. 5% volume growth probably beats analyst expectations of 4% growth. But this is not how things should look like in a $2,000 per capita income economy. You cannot have auto sales going down 20%. See, these auto sales going down 20% will take 25% growth for them to just come back to the same level. If your Godrej consumer tells you that things are gloomy, if your HUL says that things are not very tough, and these are soap companies, these are mosquito killing companies, if they are speaking of a slowdown, things are really not so good on the ground level.
So therefore, stay out of consumer names or staples as well. HUL, what's the verdict, or a Dabur or some of the others? What do you do there?
See, these are proven modes. Look at Asian Paint as well, Neeraj. I'm just giving you an example. The volume growth last quarter was 2%. What happened? The stock went from 1450 to 1500, and now the stock is back to 1420, 1430. These are proven modes, so they will probably come down 10% if numbers come weak, but markets will stay there till the time markets don't find alternatives. The problem, Neeraj, is that if everyone's a fund manager, retail is out of the game. So these fund managers don't have choices. So they're getting into places for safety. Where does a fund manager go? There is in small caps and mid caps, there is absolutely no growth. Believe me, Neeraj, there'll be less than 5% of your companies will grow at 15-20% this quarter. It's going to be a disaster of a quarter. But that is the Indian government is like the Indian police. They come when all data has gone bad. Look at the NBFC crisis as well. They came now with a 1 lakh crore bailout. NBFC crisis started with a confidence crisis. It went into a liquidity crisis, and now it's become a solvency crisis. And this is when the government has acted after 8 months, 9 months of NBFC crisis. The same thing will happen in this quarter's GDP data. When this quarter's GDP data will come out, last quarter was 5.8%. I can virtually guarantee you, if that data makes any sense, this quarter will be at least 100-150 bips lower than 5.8%. So if when that data comes, when your normal newspapers like your Times of India, Nav Bharat Times, those kind of papers start speaking about economic crisis and job crisis, that's when this government's going to act. India self-corrects. I've seen 2013, and that was a painful period. India will auto-correct, but let data come bad. That is when the government's going to act, and it will auto-correct at some point of time. That's basically our view. On consumer as well, there will be some places where there will be PE derating. Just coming to your point, there will be places where there will be PE derating in the lower consumer names. Not the FMCG ones will also probably have some PE derating. But Neeraj, where do you go? Like that's a massive problem. So it's very, like, how long are you going to bid up these 25, 30 stocks for safety? That becomes a problem for a fund manager.
Mm-hmm. Well, probably as long as this pain lasts, that's the only resort you have. Amit, good morning to you. While we were talking about these few safety stocks, you can't miss out the Bajaj twins and the HDFC twins that have been, flag bearers of those safety stocks. But commentary there too now starting to look slightly weak. And does that prompt you to take a look at these stocks in a way that you might actually even want to replace them, or these are just a few days of correction because of the fact that they were so stretched out with the kind of influx of money that came into these counters that it may actually just be okay to be in them?
Devina, there are two very different things. HDFC Bank, if you see this con call, and I've been hearing that con call for the last many years. This is the first time when HDFC said, we see weakness in corporate book, we see weakness in farm, we see weakness in SME, and consumer is the only probably place where we can grow. But they don't even do housing finance because HDFC, the parent company, does the housing finance part. So how will the 20% growth come? So it becomes difficult. But HDFC on a dip will be a good buy. I don't see, we don't own it in our portfolio yet, but we are looking at it on this dip. HDFC was a 30% growth company. It then became a 25% growth company, and now it's around at 18-20% growth company. Till the time, in financials, the most important thing is not growth. The most important thing is the ROE that a company can have. HDFC has consistently had an ROE of between 16 to 18, 19%. If ROE stays here, your 4 times price to book will sustain. If market believes that the ROE will come to 12, 13%, then your book values will start coming. And you know what we expected, because of the NBFC crisis, we expected that there'll be massive market share gains for these financial companies. But that's not happening. DCB grew at 13%. Kotak yesterday grew at 18%. HDFC at 17%. This is not what we expected. The markets were expecting that 25% of NBFCs are now out of the game. This is the time when these private financials will go out there for a killing, but that's not happening at all. In fact, they are also slowing down. It just tells you about the system slowdown. The slowdown is so bad that even these private sector banks are finding it really difficult to grow. Look at Titan. It's a class franchisee. And they have given a guidance of 20-25% growth. They grew at 13% this quarter. So it's been tough. But as far as Bajaj Finance goes, this company is adding 25 lakh clients on a quarter. This quarter also it added 25 lakh clients. The AUM growth was fine. It was 41%. The PAT growth this quarter will be 45-50%. I don't see any problems there now. Basically it is expensive, Bajaj Finance. You have to wait for dilution to happen. So your 9 times price to book. So whenever, I believe by December, Bajaj Finance will have to dilute, and that's when your price to book starts looking cheap again. So Bajaj Finance remains a very good franchise for now. And yes, there are only few businesses. Look at last 10 years. How many businesses get better with size? Bajaj Finance, the last year it grew at 40-45%. For the last 10 years, Bajaj Finance has grown at, I'm speaking about AUM, it's grown at 38%. So with size, Bajaj Finance is not getting worse. Typically, as your size increases, you keep getting worse. But this is a platform kind of business which keeps getting better with size. Bajaj Finance looks good for us now. HDFC, if we get a dip, a good enough dip, we will look at being buyers there. There's no problem in this is a small 1 year problem, but this problem will go away. HDFC will keep compounding.
Okay, so probably at these levels, then it doesn't look all that bad.
The other one, Amit, is Zee. They've come out with a statement post the results talking about how they've got one binding offer and one is expected to come. Is that a good enough trigger for Zee Entertainment and maybe even Dish TV?
Neeraj, the way that HDFC AMC, so I look at other things. It was not what management says. When HDFC bets his own reputation on Zee Group, I believe that there is something which HDFC knows that we don't know. They hold 1,200, 1,300 crores worth of Zee Entertainment pledge shares. So this deal is gonna happen. This is very certain. The price, I have no idea, but typically analysts believe it will happen between 450 to 500, and there'll be new promoters. So that's the game there in the short term. Long term, this asset is good. There's nothing wrong with it, but we don't have very strong. Let's see, let the new promoter come. Let's see who's the new promoter. But this deal will happen for sure. There will be no, in my belief, that there will be no markdowns that these banks or companies will have to take. In fact, you should look at companies which have exposure to Zee. If there's a bank who's struggling because of Zee exposure, this exposure will get resolved in no time.
Tell you, Yes Bank has exposure to Zee, Yes Bank has exposure to DHFL. If those deals are happening, is there a tactical trade to play Yes Bank, Amit? I'm just wondering. I'm not saying you would play it, but since you're talking about that, is there a tactical play out here?
The maximum I can go down to is IndusInd Bank, Neeraj. So Yes Bank is way too below our kind of investing. So we don't own IndusInd Bank either. But Yes Bank, let a new private equity guy come. See, it's not a retail franchise. We've seen what Warren Buffett did in 1964. He invested in American Express, but American Express was a massive retail franchise. Yes Bank has 15% of his loan book, which is retail. 85% is corporate. Out of 1,200 branches of Yes Bank, only 300 are profitable. 900 branches are loss-making. This is not a retail franchisee at all. So how do you come out with franchisee value? Let a new private equity guy come. We'll buy 20% higher. We won't buy it any which way, but buy 20% higher. But you will buy 20% higher from $90 or $80 or $60. Who knows? So this like at 20,000 crores, Yes Bank is not a bad deal at all. But let a new guy come. Let's see what happens. Like we're not going to buy this.
Okay. Yes Bank there. 90 odd on the stock, went down to about 86 odd, and then from there it's bounced back a bit. But still, the clouds are not going anywhere. The overhang still on Yes Bank on many counts.
The other one, and the other couple of companies that have done well. United Spirits, the optical numbers seemed okay. That stock didn't do too well, but Radico Khaitan, taking a leaf out of the EBITDA margin, the gross margin performance of United Spirits, did very well yesterday. Is up about 1.5% today. 308 is Radico Khaitan and counting. Amit, do you track the liquor companies? Do you have a view on Radico Khaitan?
I don't have a view on Radico Khaitan, but in MNCs will do well. Both these guys, a portfolio of UBL and United Spirit would ideally beat the Nifty in the next 10 years by at least 5, 7, 10% CAGR every year. So we've done a lot of math on this. United Spirits came out with blowout set of numbers. There were a lot of one-offs in it, but clearly the EBITDA margin of the 10% that they were doing for the last few years, that is behind. This company is now a 13-14% EBITDA margin company. They have got the premiumization side right. Over the last 5-6 years since they have come, they have done massive cleanups in their own books, and their business model is now very clean and clear, that they will focus on the premium side. On the less than premium ones, they will give it as a franchisee to other guys and then become cash machines. So this looks good to me. Like we don't own United Spirits, but it looks extremely good to me on a dip, like if we get a reasonable dip.
Okay. Got that. Great chatting with you, Amit. Great to get your thoughts going. Appreciate you taking out your time.
Thank you.
And joining us this morning.